So let's talk about some more real world kinds of questions. You know, what variables do we need to consider when we're thinking about borrowing? Certainly, taxes and transaction costs are part of that. So we have a little bit of a graph here, if you will, that we can look at some variables. So here are the variables that we want to talk about, right? How do these things impact the financing decision? And as you notice here, right, management incentives, tax benefits, market signaling, all have the importance or the consequence of trying to raise debt, while flexibility and distress costs are on the side of equity. So as these things become important, you want to borrow more. As these things become more important, you want to issue more stock. So let's think about tax benefits. We've already talked about this. We know that interest is tax deductible. So if you lower the tax bill, then that will leave more cash left over for investors. It makes some sense. So again, if you have a company that is very profitable, has no chance of having negative income, borrowing will provide benefits. Distress costs. Increased debt leads to higher expected costs of financial distress. So bankruptcy costs are very expensive, right? It might mean more legal expenses, the sale of company assets at fire sale kinds of prices. So we have to ask questions, right? Do we have assets that we could sell off? Or are assets typically hard or soft? For instance, take a company like Microsoft. A majority of their assets are intangible, right? You can't sell intangible assets that well. Hard assets, capital, you can sell. What about any indirect costs? And these, quite frankly, I think are much more expensive than some of the other costs, right? You could lose sales, right? Customers understand that you're in financial distress. They need to buy stuff. They're going to go out and find somebody else to do that. Likewise, your suppliers are going to bail because they might be worried about you not being able to pay bills in the future. So there are lots of costs that we really have it's very difficult to quantify lost sales, right? That's hard to do, but they're real. They're going to be experienced. How do we do that? That's an important question. What about conflicts of interest, right? I mean, if you go for broke and it fails, debt holders ultimately pick up the tab, right? Because in the end, shareholders will only, since debt holders have provided some funding here, right? They're the ones that ultimately lose value. If you go for broke but it works, then equity holders benefit and bankruptcy is averted. So again, there's lots of conflicts involved with trying to understand the process and what happens in the end. How is management going to react? What decisions will they make? Debt holders aren't stupid, right? So they anticipate if companies have higher debt, they may want to still buy the bonds of this company, but they're going to expect something. They're either going to expect higher coupons or higher rates of returns. And if they want a higher rate of return and or coupon, the costs go up. So again, if the cost of financing goes up, if the cost of anything in the business go up, the value ultimately declines. So let's think about our checklist here. We have a summary checklist so far. We need to keep the following in mind. The interest tax shield is important, right? Because it is over the life of the debt. It's not a one-time thing. If you borrow too much, increased probability could add extra risk. Now, this is important that we're only saying probability, right? The chance is there. As long as you are profitable, the increased probability is actually minimal, even if you have a lot of debt. And finally, if you do go bankrupt, right, the cost obviously occurs, right? You can't avoid the cost if you go bankrupt. So next, let's think about that flexibility component, right? Using equity opens up some borrowing capability, right? So again, if you have the ability to borrow and stay competitive, right, that's great. But if you can issue some stock, that gives you some flexibility in not having to necessarily borrow, right? So cash is king. So we should finance while it's possible using equity if it's available and not too expensive. Why? Because if things do squeeze on the debt side, debt becomes either more expensive or more difficult to get, we have a greater borrowing power because we have less debt. So one of the questions is, should you issue debt or restrict growth? If you remember, we talked about the sustainable growth rate, right? The profit times retention times the asset turnover times equity, our equity base. The connection to financing is through retention and the equity base. Increasing retention, increasing R, and increasing leverage, right, leads to increased sustainable growth. So therefore, you have a trade-off. If you issue less debt, right, then you'll be paying additional dividends to shareholders. Ultimately, that's going to lower the growth rate to investors, right? So again, there are many variables that affect this sustainable growth. Gives us a picture of how we must finance. Can we finance all with profits, or will we have to go outside the company? What's the prudent thing to do, right? Managers need to recognize, they refer to them here as the true risks. There are so many variables, some of them intangible, that they really need to balance the benefits of higher leverage against the costs of higher leverage. Too high of a leverage ratio is going to heighten the risk that the decisions that we make, ultimately they just might collapse, and everything's going to fall into the hands of our creditors because they have the interest in the company more than the shareholders. Financial flexibility might argue for equity financing, but we do have a couple of questions, right? Lenders are wary about lending to companies that already have too high debt ratios because the probability of debt is higher. So keeping debt equity on the low side, again, kind of serves like a little bit of a buffer. If you need debt, you can go out and get it, right? So you want to have this excess borrowing capability if at all possible. Next, we want to talk a little bit about market signaling. And I think this also is kind of important, but it's a little bit hard to think about. So let's think about this. If you are an investor and you own stock, when would you ever sell your stock? Now, there's lots of answers that really have nothing to do with this kind of topic, right? But the basic idea is, if you thought the stock, if the stock price is $50 and you thought the stock price was going to go to 60, would you ever sell the stock today at 50? Again, if you thought it was going to go to 60. And the answer is no, right? So you would never sell stock if you thought the price had a chance of rising. Likewise, you would never buy a stock if you thought the stock price was going to drop in value. So think of companies issuing stock like investors buying stock or selling stock. So companies don't want to issue, I'm going to put in quotes here, sell stock if they think the stock price is going to go up. They only sell if they think the stock price is going to go down. So when managers issue stock, shareholders look at that as a bad sign that management thinks the stock price is too high and it's going to fall. So when they issue stock, this is a signal that times are bad. This is why, again, market signaling typically leads more often than not to companies wanting to issue debt because it doesn't have that negative impact to shareholders. So does issuing new equity lower earnings per share? That's kind of a loaded question, right? It can if earnings stay the same. But they make a very good point here, and they say, if you issued new stock, I'm assuming you're buying something. If you buy something that makes money, earnings should go up. So earnings should never stay the same if you invest in capital and equipment. So dilution technically happens, but it only happens if there's no change in earnings. And of course, we only buy things with the indication that value, cash flows, profitability will ultimately increase. So again, that's the end of this video. We're going to take a little bit of another look here with another discussion on financing. See you soon.